Welcome back to Financial Market Insights for Traders. I'm your host, Sophia. And today we're diving into a topic that's shaking up both Wall Street and Main Street. We're talking crypto and macro, and more specifically, what retail investors absolutely need to know about how these two forces are colliding. Whether you're deep into Bitcoin, just bought your first altcoin, or you're watching from the sidelines wondering if crypto has a real place in the global economy, this episode is for you. We're covering it all: the Bitcoin impact on the economy, cryptocurrency investing risks, and the digital assets macro trends shaping financial markets in 2025 and beyond. So grab your coffee or whatever powers your trading, and let's jump right in. So here's the deal. Crypto used to be this fringe thing. You know, magic internet money traded in the dark corners of the web. But those days? Long gone. Today, cryptocurrencies are part of the global macroeconomic conversation. We've reached a point where Bitcoin doesn't just move because Elon tweets. It moves because the Federal Reserve tweaks interest rates or a central bank hints at a policy pivot. And that changes everything for retail investors. Let's break it down. Bitcoin's real economic footprint first off. Let's talk about Bitcoin's impact on the economy. What does this asset, born out of the 2008 financial crisis, actually do to the world economy? At its core, Bitcoin is designed to be scarce. Only 21 million coins will ever exist. That's a direct contrast to fiat currencies, which central banks can print endlessly. And in inflation-ravaged countries, think Venezuela, Argentina, Zimbabwe, Bitcoin is more than speculative. It's a way to store value when local currency is collapsing. Bitcoin has become a financial refuge. In these places, it's used for remittances, for payments, even to escape authoritarian capital controls. That's a profound economic impact. At the same time, we're seeing it integrated into institutional portfolios. But here's where it gets interesting. Bitcoin was once seen as a hedge, a safe haven. But as big money floods in, it started behaving more like a risk asset, correlating with equities, especially tech stocks. So now, instead of Bitcoin being an island unto itself, it's tied into the broader economic system. When the S and AMP wink with tongue sticking out drops, Bitcoin often follows. And when the Fed raises rates, yeah, Bitcoin feels that too. The macro factors you can't ignore. This brings us to the macro environment and how it influences digital assets. Interest rates are the first big one. When central banks hike rates, borrowing becomes more expensive. Liquidity dries up. That hits risk-on assets, including crypto, hard. Next is inflation. Theoretically, Bitcoin should be a great hedge against inflation, right? But reality is more complicated. While it does perform well in inflationary outlooks, during actual inflation spikes, it's still volatile and sentiment-driven. People don't always want volatility when prices are surging at the grocery store. Then there's quantitative easing. In 2020 and 2021, when central banks injected trillions into global economies, risk assets boomed, crypto included. But when that money printer shuts off, like it did during tightening cycles, we see prices crash. This macro liquidity tide lifts all boats, and when it recedes, well, we all remember 2022. And let's not forget geopolitical risk. Bitcoin adoption spikes in conflict zones or authoritarian regimes. During the Russia-Ukraine war, crypto became a lifeline, both for donations and for ordinary people trying to move money when the banking system failed them. So yeah, macro matters a lot. The risk side of crypto investing now, if you're retail and you're dabbling in crypto, you must understand the risks. And I'm not talking about losing money on Dogecoin memes. Let's start with volatility. Crypto is wild. A 20% move in a single day. That's not a crash, that's Tuesday. If you're not managing risk, you're gambling. Then there's regulatory risk. The rules aren't fully baked yet. In the US, the SEC and CFTC are battling over jurisdiction. Entire tokens could get classified as securities and vanish from exchanges overnight. And internationally, it's a mixed bag. China banned crypto mining. El Salvador made Bitcoin legal tender. The global legal landscape is volatile in its own right. Next, security. Hacks, rug pulls, phishing scams, you name it. billions have been lost. Even major exchanges aren't immune. And if you're self custodying, one lost seed phrase and your assets are gone forever. And unlike stocks, most crypto assets don't generate income. No dividends, no cash flow, just narratives. That makes valuation tricky and increases your exposure to sentiment driven price swings. So, yeah, don't underestimate the risk. But also, don't ignore the opportunity. Digital asset macro trends for 2025 and beyond. Let's flip to the opportunity side and talk macro trends in digital assets. First, institutional adoption. It's not just retail anymore. BlackRock, Fidelity, even sovereign wealth funds are here. Bitcoin ETFs are launching. That adds legitimacy, but it also ties crypto tighter to traditional markets. Then there's the rise of CBDCs, central bank digital currencies. Over 100 countries are working on their own digital money. These aren't decentralized like Bitcoin, but they show that blockchain based financial infrastructure is going mainstream. Tokenization of real world assets is another big one. Imagine trading a fraction of a building or a vintage car on chain instantly without middlemen. That's happening. Real estate, stocks, art, it's all becoming digitized. And of course, DeFi or decentralized finance. Lending, borrowing, trading done peer to peer without banks. While the sector is still early and risky, it represents a structural shift in how we think about capital markets. How retail investors can actually navigate this space, all right. So, what does this all mean for you, the retail investor? First, use smart tools. You need platforms that are built for both crypto and macro. That means clean interfaces, robust analysis, and serious speed. If you're ready to step up your game, check out Crystal Ball Markets. Their trading app is modern, powerful, and actually user friendly, which is rare in this space. Second, stay informed. You can't win in these markets if you're not learning constantly. The landscape changes fast. If you're looking for clear, beginner friendly analysis of macro trends, investing strategies, and financial markets, tune into the Crystal Ball Markets podcast. It's packed with insights, minus the jargon. Third, diversify. Don't put all your eggs in the crypto basket. Use it as one piece of a balanced portfolio. Think of it like hot sauce, great in moderation, but too much can blow everything up. Fourth, have a thesis. Know why you're investing. Are you looking for long-term growth? Inflation protection? Fast trades? Define your goals and stick to them. Don't chase pumps. Don't buy because Twitter told you to. And finally, think long-term. Yes, crypto moves fast, but real structural change, macro-level change, takes time. If you zoom out, you'll see the big picture. The digitization of finance is happening. Don't get distracted by daily noise. All right, that's a wrap on today's episode of Financial Market Insights for Traders. We covered a lot, from Bitcoin's economic footprint to macro triggers like interest rates and inflation, to the trends shaping digital assets for years to come. If you're ready to trade smarter, not just harder, visit crystalballmarkets.com and get started with a cutting-edge trading app built for the modern market. And if you want to keep sharpening your edge, subscribe to the Crystal Ball Markets podcast. They'll help you stay informed, focused, and in control of your financial future. Thanks for listening. I'm Sophia. Stay curious, stay disciplined, and stay ahead of the market.